Balance sheet ratios every investor should know. First is the quick ratio. This answers the question, can the company pay its bills? The equation here is cash and equivalents plus receivables divided by current liabilities. So cash and equivalents plus receivables divided by current liabilities. This number is below 1, that means the business is fragile. If this number is above 1.5, that's a really good sign for investors. Number 2 is the current ratio. This answers the question, how well does the company manage its assets? The formula here is current assets divided by current liabilities. So current assets divided by current liabilities. If this number is below 0.7, that means the business is fragile. If it's over 2, that means the business is anti-fragile. Next is the debt to equity ratio. This ratio answers the question, how much leverage is the company using? The equation here is total liabilities divided by total shareholders' equity. So total liabilities divided by total shareholders' equity. If this number is above 2, that means there's more debt liabilities than equity and the business is fragile. If it's below 0.7, that means there's more equity than there is liabilities and the business is anti-fragile. Finally is the goodwill to asset ratio, which answers the question, is the company growing organically? The equation is goodwill divided by total assets. So goodwill divided by total assets. As a guide, if this number is over 50%, the company is growing through acquisition, and if this number is under 10%, the business is primarily growing organically.